Thank you to all the panelists and guests this afternoon for joining us at our Stockholm+50 event, co-organized by UNCDF and Sida. The topic for today's conversation is how to fill the gap with loans and guarantees in LDCs for clean energy, climate, and women economic empowerment projects. We want to share experiences and perspectives on challenges and opportunities for how guarantees can be effectively used to enable sustainable development pathways for LDCs towards achieving a healthy planet for all. With that, I would now like to invite Ms. Suzanne Kroof from Swedish International Development Agency. She's the Deputy Head for Global Sustainable Economic Development. She coordinates Sweden's global strategy for sustainable economic development, which aims to lift people out of poverty by supporting inclusive and sustainable economic development, growth, and livelihoods. With that, the floor is yours, Ms. Kroof.
Thank you, Abhishek, and thanks. Great to be here today. Please let me know if the sound is not good. Please feel free to interrupt and let us know. But yeah, great to be here. And I think, great that we're able to host, Stockholm is able to be part of the Stockholm+50 conference. It's a really historic moment to look back on the past 50 years and see what has been achieved. And I think while many positive steps have been made, 50 years later, we of course face a number of challenges in terms of climate change, environmental degradation, and the loss of natural resources. And we know that the effects of these hit hardest for those living in poverty. So addressing these challenges is a key priority for us here at Sida and in Swedish development cooperation. We want to address these issues, and we want to do it in a way that empowers women, empowers youth, and definitely leaves no one behind. So events like this are a chance for us here at Sida to hear how we can continue to support our partners in their work, both with the global goals, the Paris Agreement, and the Convention on Biological Diversity. So I think this is a really relevant event to be having as part of the Stockholm+50 conference. And I think a couple of themes that really stick out more and more as time goes on, and particularly also in the conference, is the importance of two things. The first one being innovation, to find solutions to these very complex problems that we face. And the second one being financing, so that the good ideas that we come up with can be scaled up very quickly. So we see that this is where our partnership with UNCDF comes in. And I think there's some aspects that we really value in the partnership with UNCDF. The first one being this focus on least developed countries and difficult environments, reaching out to the most marginalized groups. The innovation and risk-taking definitely comes out. We really need partners that can take risks, find new solutions, test, learn from that. There's a clear focus on climate and biodiversity in the work, and also more and more exploring the transformational potential of digitalization, which we hope can lead to transformation in key areas. So the partnership is a great match with our priorities and values here at Sida. And I think in addition to innovation and financing, the other thing we need is scale. We need to be able to get these good ideas out and replicate them quickly. So this is where I think events like today come into play, where we can share experience, inspire others, learn from each other. So I see that's really the key purpose of today's session. So I'm very much glad to be here and very much looking forward to hearing about UNCDF's work with loan and guarantees, how they can fill the gap and how they are filling the gap through the bridge facility, and looking examples at the Gambia and Papua New Guinea. So thanks again very much. Look forward to the discussions. Back to you, Abhishek.
Thank you, Ms. Kroof, for your opening remarks. It is my honor now to introduce Ms. Preeti Sinha, Executive Secretary of UNCDF, who has had an illustrious career of 10 years as an investment and development banker across well-known institutions like African Development Bank and Rabobank. I would now invite Ms. Sinha to give her welcoming remarks.
Great, thank you. Thank you, Abhishek, and good afternoon to excellencies, colleagues, and friends. Oh, I think I'm on mute. Is it me? Okay, sorry, I was just checking. Good. So I'm privileged to be here today, especially at this time of Stockholm+50. Before I start, I wanted to extend our deepest appreciation and gratitude on behalf of UNCDF to the government of Sweden, to the colleagues here in the room of Sida. We always felt that the people of Sweden have been very instrumental in our mission towards being a catalytic agent towards achieving financing in the least developed countries across the world. We've always been able to count on the government of Sweden to be a steadfast partner with us. And as we know, the mandate of the government comes from the people. And issues like sustainable development require global leadership in thought and action. And we feel this demonstrated by the people of Sweden is then inculcated into the mandate of the government, and therefore very much value this partnership with Sweden, with Stockholm, with Sida, and very glad to be here today. Stockholm+50, the reason that we're all here in this beautiful city this time, reflects the seriousness of our global responsibility to steward the planet towards a healthy environment, a healthy environmental future. But Stockholm+50 also represents how the pursuit of a healthy environment can serve as a driver for practically every development theme that defines the SDG agenda. Of course, this is why one of Stockholm+50's pathways towards a healthy planet is rebalancing resource use for greater equity and promoting gender equality. In this vein, blended finance is also seen as a driver for development, for achievement of every aspect of the SDG agenda. The topic for today that we are focused on is hardly new, and it's been discussed, but we want to bring together here a really good set of examples that will illustrate the use of blended finance. We want to address today public sector stakeholders, private sector stakeholders, policymakers, levels of government, and of course, enterprises as well. The truth is, so much of the conversation has centered around how we can finally optimize the full potential of blended finance to unlock private capital in support of the SDGs in geographies where the needs are the greatest. As an organization, UNCDF sees itself as a blended economic development agency and a financing agency. And we hope to play a role in this blended finance debate by complementing grant making and technical assistance with an increased and mainstream use of the financing capabilities and instrument. That includes, of course, blended finance. In terms of optimizing blended finance as an instrument of innovative finance, UNCDF can bring two important elements to the table. By leveraging our ability to directly deploy concessional loans or guarantees into any level of public or private sector projects, which is something that is unique within the United Nations development system, we can demonstrate that investing in the last mile settings creates positive development outcomes that can be commercially viable and scalable with the right UNDP project to support renewable energy production that has the potential to remove over 300,000 tons of CO2 over the lifetime of the project. And secondly, a portfolio guarantee mechanism that facilitates easy access to finance and affordable financing, capacity building, financial literacy, and business development skill training for women entrepreneurs in Papua New Guinea. By the end of today's session, my hope is that all of you will understand UNCDF's value proposition, our instruments, and how we work. From the standpoint of financial instruments, blended finance, from a country standpoint, considering that we are targeting the achievement of the SDGs, largely in Africa, Asia, and the Pacific, and from a thematic standpoint, spanning clean energy, women's economic empowerment, amongst other themes. This finally leads to my call for action. My call for action for the private sector to continue to be an active, intentional, and robust agent for sustainable development, and to finally and fully embrace stakeholder capitalism. We need the private sector in the SDG achievements. My second call to action is to the public sector finance. As we call on the private sector, we must look as well as the public sector finance to embrace the openness to new instruments, new capabilities, and a great willingness to play a significant role as a de-risking partner for the private sector through concessional finance, technical assistance, and engagement with local and central governments. With that, I thank you and look forward to this great debate coming on. Thank you, Abhishek.
Thank you, Ms. Sinha, for your welcoming remarks. With that, I would like to now invite Ms. Fatumata Sanyang. She's the program analyst for energy and environment at UNDP Gambia for the past 5 years. She brings with her experience as a program coordinator in corporate partnership from Earthwatch Institute, and Mr. Anders Berlin, who is the director of LDC investment platform at UNCDF. He has previously had the post of head of unit for loans and guarantees at the Swedish International Development Cooperation Agency, managing a portfolio consisting of approximately 50 projects, programs around the world, mostly in Africa and Asia. Both of them would start this conversation today by doing a short presentation on UNCDF's initiative, the case of Gambia's solar power plants, which is a joint program between UNCDF and UNDP. With that, I'll turn it over to Ms. Fatum and Mr. Anders Berlin. Probably we'll start sharing a slide as well now.
Thank you very much for that introduction, and it's a pleasure to be here. So just to set a little bit of context, the Gambia is a relatively small country with a population of 2.4 million and being the smallest country on mainland Africa. And as far as the electricity situation on the ground, up to 40% of the population are still without access to electricity. And for those that do have access to electricity, it is inconsistent, with blackouts being a usual occurrence. And it's also unsustainable to an extent. I say this as the generation of electricity is predominantly reliant on heavy fuel oil-based generators. However, despite this context, the Gambia is quite ambitious in its targets and its agenda as far as the energy sector is concerned. For example, the Gambia is the first African country actually to sign up to the Sea for All agenda. Also, in the nationally determined contributions, there are very ambitious targets in there related to the energy sector and bringing down carbon emissions, as the sector is a huge emitter of carbon at the moment. Finally, the National Electricity Roadmap is very ambitious in the sense that there's an aim in there to achieve universal access by 2025, so within the next 3 years. And there's also a key emphasis on the incorporation of renewables in the form of solar, hydro, and wind. And that's where really this NAMA facility funded project comes in that UNDP is jointly implementing with UNCDF. The objective of the project is to introduce solar energy for the first time to rural Gambia. And we've identified 2 rural hubs, being Farafenni and Basse, due to the economic activity in these areas and also the demand. So the project would be replacing the heavy fuel-based generators with solar plants. And the objective would be that we would be creating an environment where the end user, the communities, would be receiving more sustainable, affordable energy. And if you could just go to the next slide, where it highlights a few of the other objectives of the project. As it is financed by the NAMA facility, there is a huge climate mitigation component. As we've said, it will be replacing the generators, so we will bring down carbon emissions, significantly contributing towards the nationally determined contributions. So in terms of the offer that UNDP has brought to the project from the design to implementation, there are quite a few things we can point out. This is going to be the first project of its kind in the Gambia. How it would work is through a power purchase agreement with the national utility known as NAWEC, and also a private sector actor that would be responsible for establishing the 2 solar power plants and managing them for the 20-year concessional period. And in terms of how they would be engaging through a PPA with the utility. And this will be the first solar-based PPA in the Gambia. So the role UNDP is really playing is the coordination role, bringing in all of the concerned parties for the first time in this context. So you're talking about the national utility, the relevant ministries such as the Ministry of Energy, Environment, the Public Utilities Authority, the Gambia Investment Authority, even the Ministry of Lands, as they all play a key role in implementation. And of course, UNDP is also offering legal, technical, and to an extent, financial support to the utility and national stakeholders. Because as part of the project, They would be responsible for identifying a private sector actor, negotiating with them, and also managing the PPA agreement for a 20-year period. So there's really a need to fill the technical and the financial and the legal gap there in terms of capacities, make sure that they're able to go through each of the stages of the project or even the agreement successfully. Now, in terms of UNCDF's role, it's very important. In fact, it's needed in order for the project to be in existence, because it's all good and well, all of the things that UNDP has to offer to the project, but how do you secure private sector engagement in a project of this scale in the first place? Because it wasn't mentioned earlier, but the utility known as NAWEC is working at a loss and they're currently in debt. So to bring in private sector investment, you really need to install confidence in the private sector actor that this would be a safe investment for them. So how do you really secure this investment from private sector? This is where UNCDF comes in. And they've provided a de-risking tool, a financial tool, through a guarantee. And this guarantee function is very pivotal to the project. The project is centered upon it, because that's really what has brought in the private sector that is needed in order for the project to be launched. And that's really where UNCDF plays a role within this project. And coming back to the slide, the project has two components, a financial and a technical one. The financial component is handled predominantly by UNCDF because it's related to the guarantee function. But the technical component is handled predominantly by UNDP. And that is what is highlighted here on the slide. Even though this technical component is managed predominantly by UNDP, you can still see the importance of UNCDF. Because if you look at the diagram carefully, UNDP's interaction is predominantly with the national stakeholders, with NAWEC, who is the utility, building their capacities, getting them through the project. But you'll notice that most of the engagement with the IPP, which is the private sector actor in this case, is coming from UNCDF, because all of the financial elements, the guarantee functions, the negotiation related to the guarantee is all handled by UNCDF. And I think it really depicts the complementary relationship that we have in terms of implementing this project. UNDP comes in with the management coordination function, and UNCDF comes in with the mandatory needed guarantee financial management role and side of things. So this is where I will stop and hand over to UNCDF, who will give some further background into the guarantee mechanism itself and how it works. Thank you, Anders, over to you.
Thank you, Papu, and great. And let me also echo that we think it's a very good collaboration that we have, and that we use our different competencies in this project. So a guarantee is an insurance, right? And when you design a guarantee, you try to design it to incentivize private sector to come in. But you don't want to be too generous and using your scarce resources. But you don't want to be too sparse with the guarantee coverage, so they're not interested. So that's what we did. We designed this guarantee to make sure that financing coming into this Gambia project, and Fatou told you about some of the challenges with NAWEC, the off-taker not being financially so strong. So you needed a guarantee. Now there is. Let me say a few words on the design of the guarantee. So for those interested, there is no fee for the first 5 years. That's a long grace period for the guaranteed party. After that, it's 1.5% in fee, and the tenor is going to match the duration of the guarantee, is going to match the tenor of the loan, and that's probably going to be between 12 and 15 years. Now, there's two parts of this guarantee. One is a liquidity support. So if there is a delay of payment from the offtake in NAWEC, let's say that they are in trouble paying, then the SPV who are actually taking the loan to build the plant is not able to pay off their loan obligations. So there's a problem then for the developer, and that's when the guarantee kicks in, and it's called liquidity support. So if the off-taker is not paying for up to 24 months, then it's going to be covered by this guarantee. The second part of the guarantee is a termination support. So say that it is a termination event, then NAVIC should pay the full value of the project to the developer. Let's say, and what is a termination event? Well, it's actually now under discussion, and we're negotiating all those triggers in the guarantee agreement. But let's say that the government is taking the land that this was supposed to build or has built the power project, then that would probably count as a trigger event, and the developer cannot really operate. Then actually the off-taker is to pay the full amount of the project. Now, if NAVIC is not paying the full amount after 90 days, then this guarantee kicks in, and 70% of the value of the project is then paid from the guarantee. So with these two, delayed payments and termination of the project aspects of the guarantee, it actually covers quite a lot of the risk that the developer sees before they go in and invest. And with that design, we have a developer that's now investing in this project. Over.
Thank you, Anders. That was very helpful, and we'll continue the conversations on guarantees going forward as well. But with that, I would like to now invite Mr. Jagdeep Dahiya, who will talk about the portfolio guarantee in Papua New Guinea to support women-owned MSMEs, which is a UNCDF, UNDP, UN Women joint project implementation. Mr. Jagdeep Dahiya is UNCDF's local transaction officer in PNG. He is an international development professional with almost 2 decades of experience working for economic empowerment of vulnerable segments, especially women, youth, and rural communities. He has led the work of UNCDF in PNG through the Pacific Financial Inclusion Program, and he is leading UNCDF's work on financial inclusion for agri-value chain players under the PNG Street project as well. So with that, I will turn it over to him to do a short presentation on this project. Over to you, Jagdeep.
Thank you, Abhishek. I'll just quickly share my screen. If you can confirm if you can see my slides.
Yes, we can see your slides.
Great. So good morning, good afternoon, good evening, colleagues. I'm joining from Papua New Guinea, a small Pacific Island country just north of Australia. And I'll take you through a few interesting facts about PNG before we get into the details of the product. So PNG has earned the land of unexpected, one of the most diversified countries under the sun, with 900 plus languages and tribes. Looking at the economic and demographic aspects of PNG, it's a country of roughly around 10 million population. It's a middle income country with a GDP per capita of US $2,500, with roughly around 25 commercial institutions into the financial space. What is interesting is that though the commercial institutions sit on high liquidity, they are usually quite risk averse in terms of funding entrepreneurship and MSMEs in particular. And that situation becomes even more difficult when it comes to women-led MSMEs. So country has roughly around 37% people below the poverty line, and it scores exceptionally low when it comes to gender equality index, and it is in the bottom 10 globally. Also, the incidences of gender-based violence are exceptionally high, with 2 out of 3 women reporting gender-based violence during their lifetime, according to the studies. It also is geographically very difficult with rugged terrains and underdeveloped infrastructure. 85% of the population is off the grid, and barely less than 10% of the population have access to internet. Looking at these different scenarios and these different aspects, it becomes exceptionally difficult for women entrepreneurs to thrive, and they are often left out of the financial inclusion space, and particularly they find it much more difficult. They found it much more difficult during the COVID times. So this guarantee that we developed with support from UN Women and UNDP, both colleagues are here on the call, is an attempt to basically ensure that the private sector financing flows into this particular segment, which is defined as the qualified borrowers for the guarantee. And this includes women-owned and women-run micro and small enterprises in the formal sector, and also specifically on the market vendors and traders who are operating in different parts of the country. So this portfolio guarantee is the first ever portfolio guarantee that is established by UNCDF. And it is the first loss guarantee of 25%, which basically means we are able to leverage 4 times the funding from the private sector. The partner that we are working with is Women's Microbank Limited. A bit about this institution. This institution is the first women-focused institution in Pacific and perhaps the 5th in the world. And we started working with them in 2018 when we developed a biometric-enabled solution for them to be able to go out into the rural communities and rural areas. And it's a low-cost branch kind of a model that we are able to promote. The benefit of that has been that barely from 8,000 plus active members, when we started working with them, they have grown to 85,000. And that also has increased the need and demand for financial services by women customers that they serve. So this is how this whole thing comes together. This is a total guarantee of 450,000 US, which basically means that with a 25% first loss, we are able to dedicate 1.8 million US dollars going to women entrepreneurs for their economic development. Looking at the whole of the guarantee structure, the additionality that this guarantee is able to bring for the people and the target beneficiaries, we looked at what were the specific barriers and challenges that the women in PNG were facing. And one of that was the high collateral demand from financial institutions, and also a requirement of a minimum deposit. Both these things has been reduced. The collateral demand from 50% to 15%, and waiving of completely the minimum deposit requirements. The loan tenure will be increased from 6 months to 12 months. And in addition, it also comes with a subsidized rate of interest, which is reduced from 36% to 24% for the people who are covered under the guarantee. Moreover, while looking at the different risk and the pricing, we have tried to keep it as close as to the market forces. And over the 2 years, this will be a test case for us to take it to scale. Currently, it will be applied in 4 different regions of the country, and there are plans to expand this further. It's also important to understand that the guarantee doesn't come in a silo. Along with the guarantee, there has been also other support that has been built around it, which includes financial and digital literacy, and also business development skills training, and the expansion of the banking access points, taking these access points closer to the women entrepreneurs and to the markets where the women vendors operate, which then makes it much more easier for them to access not only the loans through the guarantee, but also enhanced stability in terms of making the savings. That's broadly in a nutshell what this guarantee has been in Papua New Guinea. Back to you, Abhishek.
Thank you very much. Thank you very much, Jagdeep, for this presentation. This is a great example of how different UN agencies are working with partners like SIDA and also the private sector And for further discussion into this topic, I will now hand it back to Anders Berlin to moderate a panel discussion and also introduce some of the other panelists who have not been introduced. Over to you, Anders.
Excellent. Thank you, Abhishek. And I'm very pleased to moderate this panel with these excellent panelists. So in our panel today, we have Mr. Kalle Hellman. He's the Deputy Head of Guarantees and Catalytic Financing for Development. Maybe you can wave, Kalle, so they know who you are. Great. Thank you. And then we have from Women's Microbank, the CEO Gunandi Das. Maybe you can wave as well. Great. Super. And from UN Women, we have Caroline Nyama-Yoko, Deputy Country Representative. Great. And then from UNDP, we have Edvard Rikic, Deputy Rep at PNG. Great. So super. Just a bit of housekeeping. So if there's any questions, you're most welcome to put them into the chat, and we will try to see who could best respond to them. And also maybe you'll if you put a question, maybe also tell your name and organization so we know from what origin it is. Now, before diving into the panel, I just want to say a few points. So UNCDF's sweet spot is really to fill the access to finance gap faced by many SDG positive SMEs and projects in the LDCs. That's really what we're driving for. Now, if we go back to the Addis Ababa Action Agenda, it was really prompting us all in development finance operation to use both public and private funding to finance the SDGs and SDG positive businesses. So how are we doing, right? And we have a publication almost yearly, and we look at how ODA is used. And of all ODA going to mobilizing private sector finance for SDGs, only 7% of that goes to the least developed countries. So 93% goes to richer countries. Now, if you look at another point, so IDA received 5 billion in 2017 to spend on private sector projects and companies in IDA countries. It's a little wider definition than LDCs, but it's the poorest segments of countries. Today, only 2.2 billion of those 5 billion have been spent. And actually, only 700 million has been dispersed. And of that 700 million, 500 million is an MEGA guarantee. So obviously, we're not doing so well when it comes to trying to mobilize private capital to the least countries. And that's really what these two examples have tried to show how you can do that. So with the two examples in mind, and with these points that I made, I would like to dive into the questions for our panel. And I want to start with Ed. So Ed, maybe you can elaborate a bit on what was UNDP's interest in supporting this transaction that was just recently presented by Jagdeep, because you were doing so. Over to you.
Thanks, Ed. Thanks, Anders. Good evening to everyone from the other side of the world. So it's nice to be here. It's a pleasure and good to see colleagues online as well. And it's great question. I mean, I think there was essentially a number of areas that we could see. The partnership we have with UNCDF as part of a much broader strategy we have, targeting very much efforts to ensure no one's left behind. Papua New Guinea is a very complicated landscape, and it sits between the Pacific and Asia in many respects. I think for us, what we saw was an opportunity very much to achieve three needs, or respond to three needs. And the first was the value add. It's quite an interesting market, and I use that term rather broadly in the PNG context, but certainly the nature of the private sector is very much dependent on extractives. There's the big end of town, which is mining and agriculture, and about 40% of the economy is informal, and we know of that about 65% headed by MSMEs, generally women. So the problem that we saw was, and I think someone alluded to this, might have been Jake Deep, it's never been a question of liquidity in Papua New Guinea, but rather affordable credit in the way that the market prices risk. So the idea of a guarantee to target small and micro businesses was pretty evident when you started looking at the role of women in the socioeconomic fabric, particularly in Papua New Guinea. I think the second thing that we really wanted to do was try and shape the market a bit. Shaping the market is very important because it's quite a conservative market. There's a lot of scope for change and for modernising the way people are thinking. You see it in the way that risk is assessed and viewed, and the way assets are managed, etc., and support the businesses. And then finally, I think we could see an opportunity to start crowding in some finance. What we find here is that, like in many parts of the world where you can demonstrate success on the ground, you start to raise interest, and that's a very important thing for us. So it's kind of the drivers for the desire to want to partner with UNCDF. The guarantee is important. It feeds into a lot of work we're doing with respect to addressing women's empowerment, women's leadership in political spheres and senior public spheres, but also looking at recognising the importance of driving that economic development in micro businesses, looking at the paradigm with respect to credit, but also having a very careful think about where is the absolute strategic value add. I'll leave it there, Anders.
All right, excellent. Thank you, Ed. And I really, what really makes sense to me is the market development point that you were making, that UN agencies, we can be there, we can break new land, and then show the market, show market actors what can be done. Great. So and this is collaboration with many UN agencies. So we also is having UN Women as part of the collaboration. So I want to turn to you, Kalaran, and ask you, so how do you think this guarantee that is now implemented is supporting UN Women's mission in PNG? Over to you, Caroline.
Thank you, Anders, and good evening. For UN Women in Papua New Guinea, we are working towards improving women's income security. And some of the challenges that we have been facing in achieving that goal has been around being able to support women-friendly financial services, being able to also address issues of the risks that women have faced in accessing some of the loans that are available in the informal economy, which have very exorbitant interest rates. We have had issues with the way that we have supported women, like grants. In the past, we have done a lot of support to income generating activities where we give women grants, and this evidence has shown us this has not been sustainable. It has not really led to any transformation in women's income. And so this grant this guarantee that we have worked out with UNCDF has enabled us to actually ensure that women can have subsidized loans. The requirements, as Jack Deep has explained, have been made minimal. A lot of women, like in the context of PNG, who are working in the informal sector, do not have some of the documents, some of the requirements, the collateral, the minimum deposits that most commercial banks would require. And this partnership with UNCDF enabled us as UN Women to be cushioned, because they came in and they were the facilitator between UN Women and the microbank. And so we are finding that we are now able to reach more women with this finance. And women are also benefiting not just from getting the loan, but they are accessing business development services, which for us is a critical part of them attaining that income security, the ability for them to be skilled on how to diversify their livelihoods, how to also tap into new markets. And again, working within associations is giving them an opportunity to grow their business and hopefully transition from the informal to the formal sector. So multiple benefits that have just come in through the guarantee.
Excellent. Thank you very much, Caroline. And I think from UNCDF's perspective, we've seen that it's very important to pair finance with business development support to make successful, especially when there are first-time borrowers. So good point there. I now want to turn to the CEO of the Women's Microbank, Gunandi Das. Because you're now going to do this with the support of UNCDF, UNDP, and UN Women, and reach all these women. So maybe you can first develop, dwell on the different challenges that you as a CEO sees for expanding your business. What kind of hinders do you have? Over to you.
Thanks, Anders. Good evening, all. Once again, this is Gunanidhi, Women's Microbank. The challenges actually from two fronts actually. One is from the customer side, and another one from the organization side. When we come to the customer side, the women who are coming in the morning to do their entrepreneurship, we are not open, and when they go home, we are already closed. So giving them solution, giving them the banking in their doorstep is highly impossible for the customer point of view, and at the same time from the banking point of view. So when it comes to the challenges, mamas, if they have to come to the bank, then they really come. They leave their entrepreneurship and they come to the bank, and after that they're stranded for almost 3 to 4 hours to do banking, and then after that the challenges they have that Caroline already mentioned, that the KYC and then all other things is actually really a challenge to make them bankable. So when that is the customer side, and customer benefits or customers are not really incentivized to do banking. And at the same time, when it comes to the banking side, we as a banker, we are ready to go, but we don't find it out that solution, that how we can go out to a unbanked population, vulnerable population, where the market or the particularly we can talk about like the security concern in this country is the real microfinance is not able to do in each part of the corner of this particular country. So that's where actually we see that giving out a loan is not a big deal, but when it comes to the repayment, if a mama is really coming into with any problem or anything, and getting that payment back is like if we are giving $100 or $200 loan, getting that back is making us $500 expenses. So that's the major issue we see, and at the same time that how we can make it that the challenges more attractive to the customers, so that they can able to avail that solution, but more importantly at their doorstep. With UNCDF help, what we did is actually, and also UN Women, we as Jagdeep already mentioned, through biometric enabled solution, we are going to the marketplace where mamas are not able to not have to come out from the market. They can able to do the banking within the market, and at the same time they not only they can avail the credit, they can also create their savings portfolio so that they can go to the next level. And more importantly, as Caroline mentioned, that capacity building of that particular mamas is more important, so that they can be credit worthy in the long run. So those are the actually challenges we always feel, and those are the ground reality, and that's the reason actually this credit guarantee scheme is going to be the handy for Women's Microbank and the mamas in Papua New Guinea.
Excellent. Thank you very much for giving that very concrete explanations on some of the challenges that your customers are facing and as you are facing as a bank. Now, I want to go to a second round of questions. I want to have an overall questions for all of you, and that is, when I was speaking about the small funding going from ODA to actually mobilize private sector engagement in LDCs and the World Bank's challenging in just spending some of the money to get. How can we actually redesign the international development finance architecture so more investment capital goes to LDCs? I think these two examples are excellent of how we're trying, right? But how can we scale that? So why don't you think about that very difficult question for a second, and I'll if you have any response, I will be very happy to hear from you. Now I want to turn to Kalle, who is the deputy head at Sida for the guarantee unit here, and I wanted to understand a bit from you, Kalle. How can a guarantee agency reach the last mile beneficiaries, like the one that Gunnar Nidi is lending to, and still be cost efficient?
Thank you, Anders. And thank you for inviting me here. And I must also say that so many good things have been said already, so I will can't adjust what I was about to say here. So I would also like to perhaps rephrase or add to your question: how can we reach to the last mile beneficiaries and offer financing on reasonable terms? And from the last intervention, I would also add, in a time-effective way for both customers and others. So I think it's tricky but doable. I mean, Coca-Cola has been able to include basically the whole world's population. So why shouldn't we be able to include more with financial services? So a guarantee agency is always in need of an intermediary in one or another way, since the whole point is to leverage others' liquidity. So for reaching the last mile, fairly specialized intermediaries are needed. And we have heard here that we need to know the demand, and the intermediaries need to know the demand and the limitation of those we want to reach. I would perhaps dwell on two factors. For instance, it's risk and cost efficiency as they go together. So risks cost money. The more perceived risk, the more reward is needed to motivate investors generally. In the end, this will be paid by those who take the loan or needs the fund for investments. And unknown risks are even more costly, I would say. And perhaps, unknown risk could also perhaps prohibit financial inclusion in total. So I think that a focus also for the broader donor community must be to build institutions, including looking at laws and regulation, but perhaps also institutions such as business and credit reference agencies, land register, and so on, who can kind of give market player and others some solid ground to base their risk analysis on. I would also say that credit risks also cost money, right? So focusing on local money is key, mobilizing local money. And there is a lot of liquidity out there. We mustn't always look at the international arena because international money comes with a credit risk that needs to be paid somehow, right? So functioning local market is also it's key, and it's also a signal for investors that investments are doable. So it has a dual function in that way. So cost efficiency. So every layer costs money, right? Small transaction costs more. We know that. And again, in the end, it has to be paid either by subsidies, which is not viable in the longer perspective, or by those who we wish to reach and include in the financial system. So these two factors in combination makes it difficult, I think, for the current system to reach the last mile. So we have heard about guarantees. It can be used to bring down risks, and that is what it is meant to do. So the expectations on return should go down, which should make the financing more affordable for the end user. But we still need knowledgeable, cost-efficient intermediaries in combination with more innovation to cut down costs and do the trick. So sorry, Anders, no straight answer from me here.
I think it was a good enough. I think more innovation in the future is, of course, a universal answer, and we'll hope for that. In the meantime, there is innovation taking place, not least when we're doing due diligence and other things, which is driving down cost. And I know that you're also involved in that, so that's good. Now I want to go back to our banker, Mr. Gunanini, and ask you now. You see all this risk and you want to expand your operation. So what characteristics in the guarantee is most important for you? What kind of comfort does it give to you so you expand?
Okay, thanks, Anders. I think as a bank, we want to see the first characteristic from this credit guarantee. It should be simple and easy. So to use and manage the portfolio, which includes the reporting from the guaranteed party like us, and also monitoring and evaluation from the funding organization like UNCDF. And at the same time, the guarantee should be adequately cover the risk to venture out to unbanked and vulnerable population with new products, because when we bring out new products, we want to take that steps a little bit more adequate cover, so that we can see, like Jagdeep said, the next 2 years how it is going to work. So that cover should be there. And then it's not only guarantee, but with that guarantee, it should come with some support functions such as the capacity building, and then to the end beneficiaries, and also the blended finance. So when it comes to the capacity building, like such as UNCDF and UN Women, we are giving the banking access closer to them through the biometric enabled solution, which increase the volume of the transaction, and at the same time we give financial literacy training and business development training to ensure that they are capacitated to take take part in the credit portfolio. And more importantly, like UNCDF already helped Women's Micro Bank with a debt fund also previously. So that enhances us to reach out to the more women in Papua New Guinea, because Jagdeep was mentioning here 25 financial institutions are there. Most of them are adequately cash flow is too much, but they are not ready to go out to the to the market, particularly the unbanked and vulnerable women who are really aspiring to become the from informal to MSME to the SME sector, but unfortunately they don't have anything. For example, the collateral. Here, anyone looking for they first look at the what type of collateral you have, and when we talk about the informal sector, they don't have anything. They never gone to a bank. They never have a credit worthiness. They never have a bank statement. So, but the rudimental way of asking them all those questions, end of the day they go back and say that, oh, I'm not eligible. So that is where actually we want to see that this particular characteristics where UNCDF is coming in. We are already availing the guarantee fund is there, but I personally as a banker feel that UNCDF Credit Guarantee Fund is totally different or very unique with respect to other credit guarantee fund, and those characteristics need to be there, and I believe it is already there with the UNCDF Credit Guarantee Fund. Thank you.
Thank you very much, Gunanidhi. I think those were, I took note of 4 points here. So one is a simple use of guarantee. Secondly, that it's adequately designed to match the product offering, and also that it's compensates for the absence of collateral among your customers and the importance of technical assistance. Great, thank you very much. I'll move on to Caroline again, and I want to ask you this time. So first question is really, how can this impact be accounted for by yourself while you have another party doing the financial instrument? And then, if this is a new experience for you, what have you learned, and can this be replicated in other regions, do you think?
Okay, thank you. I think really for us, the starting point is to recognize we have a shared vision, and that is the vision for sustainable development. We want to reduce poverty. We want to improve inclusion. We want to achieve gender equality. So this impact is shared between ourselves and UNCDF, including extended to the parties who are participating, like the Women's Microbank. And this vision is also articulated within a common framework, the UNDAF, the United Nations Development Assistance Framework. So even if the guarantee is sitting with one party, there's a framework, a common framework that brings us together, in which we are using to monitor the progress. At a project level or agreement level, we have a clear results framework that we have shared that has got clear indicators. We have set in a monitoring mechanism at 2 levels. Firstly, at the field level, where we have our own UN Women staff who are based in the field, working very closely with staff from Women's Mama Bank under the overall guidance of the UNCDF technical staff. At a high level, we have a governance structure in which we are tracking, we are supposed to be tracking and analyzing the progress that we are making, and of course generating lessons. In terms of the second part of your question, I think it might be a bit early to tell because we have just started, but I think just looking at the experience we've had and the opportunities that this arrangement has unlocked for women, I would think it's worth, it's worth replicating. But of course, let's give it a bit of time. Let's watch. We are still concerned, for example, with the interest rate of 24. We still feel it's a bit high, and so we still need to look and see, can it be brought further? What do we need to be adjusting in that guarantee so that at least it's really making a transformative difference to what else was out there for women? So yeah.
Super, thank you very much. And I think it was great that you emphasized that the UN agencies have a common framework, the UNDAF, and therefore, we are working towards the same goals. And that's a nice segue to you, Ed, because I wanted to hear from you how you now have experienced this collaboration among the 3 UN agencies. And also, could there be more such collaboration, and including partners like Sida or other UN agencies that's not at the table here and now? And can that be more systemic, that we're using each other's different competencies and mandates? A big question, but I'm sure you can answer that, Ed. Over to you.
Thanks, Anders. Look. Yes, I mean, we're in the PNG context, we're very heavily orientated towards joint programming. I know my agency, UNDP, I think at the moment about 40% of our program work is joint with other UN agencies. Some are very large in the Highlands, where we have 6 participating UN agencies under a field office, and some are a bit smaller, where we're working on displacement or climate. But I think what strikes at the heart of that question is one of incentives. And I think where there is an incentive not only to collaborate, but also to underwrite, participate, and be part of that response, then you're always going to find the opportunity for joint programming. The thing that particularly appeals to us about the joint programming is not just the opportunity to leverage, but we forget often as the UN, we have a global framework. We have a global pool of expertise. We have a global experience that's now decades long. In the context of Papua New Guinea in the Pacific, the UN has been here for 40 plus years, and there's no intention that we will leave. You know, we're not driven by bilateral considerations. So for us, you know, the opportunities are very much longitudinal. We are looking over the horizon. And that becomes a very important baseline when you're designing activities, because for us, and having worked for my own government for many years, the challenge is balancing that pressure of domestic electoral cycles and talking to the UN about these 10, 15, 20-year programs. The reality is, and the elephant in the room when we talk about private engagement, is that it's a very complicated question, which we try and distill down into very simple phrases about crowding in private finance. There is an elephant in the room, you know. At the heart of it is incentives. Finance follows opportunity. I think the role for us on the other side of the ledger is to define what opportunity looks like. What are the dimensions of that opportunity? And how does that opportunity reach the greatest number of people to achieve the greatest good? And I would define good as improvements in human development indicators. We have measures, we've measured this for 45 years. UNDP leads this work globally. So that question about when we all come together, it's not just a question of how we deliver a programmatic response. It's a question about how we shape the incentives. And I still don't think as the development community, we quite understand the incentives that shape the behavior, not just of governments, of our partners and our members, but also of our investors in the private sector. I think it raises some very, very interesting questions, some of which are quite uncomfortable, about what development actually looks like. What is the nature of development? Why are we doing this? Particularly when you cast it against the desire to improve livelihoods and material benefit against the realities of climate change and the human footprint as it's expressed in, you know, greenhouse gases and unsustainable production. So I think for us, one of the things that becomes really important is, as a baseline for joint programming, not only do we work within our common frameworks, but we also need to have some very difficult discussions. Not all agencies can participate in all programs. Not all development partners want to be involved in all programs. That question of incentive and value is a critical one. But I come back to that fundamental point. I think one of the things that we continue to miss doing is defining what opportunity looks like in relation to the greatest number and the greatest good. Sorry to sound a little bit like an old Marxist, but I think there's a lot to be said about having a think about what does it really look like, and what is the opportunity cost of not changing the way we work, and what is the actual material benefit. And I know there was a mention earlier from Kale about the relationship between risk and benefit, and I think that's an important thing not to lose sight of. I think we should play high risk, because high risk generally means high benefit, but developing the appetite for risk in a domestic jurisdiction where the big 10 donors are domestic bilateral donors can be a very difficult sell, particularly around election time. I'll leave it there. I'm rambling a little bit, but I think you kind of get where I'm going with that one.
Absolutely. Thank you very much, Ed, for those wise words. And I think it's timely, because I want to come back to the to my first question on how do we try to change the international development finance architecture so we're actually incentivizing more funds going to least developed countries like PNG and the Gambia. And what can we do, right? We, of course, there is the whole governance structure with the World Banks, the IFIs, the UNs, etc. And that is one way, of course, but there might be other ways. And I wanted to put Kale on the spot and see if you have any ideas. You just had one round of comments, so here is your second round and chance to go to history. Over to you.
Thank you, Anders. Again, I mean, I will not be able to answer that question, obviously. But I mean, if we talk about the high level, we need to understand that ODA will not be enough. So we need to crowd in private capital, which we all, I mean, it's an easy phrase to say. But really, I mean, we need to spare ODA for what ODA needs to be used for. Guarantees are a fairly effective way of using ODA as well. I mean, if we look at our portfolio at Sida and look at the ratio between ODA used for subsidies of guarantees to the number which represents available financing, we have a relation 1 to 56 approximately. So I like to kind of quote the investor that I talked to recently that said, he said that I mean, money is not really the challenge when it comes to financing of bankable investments, because there is money for that, and then finance instrument has given us a way to tap those resources. So it's still a complex instrument. We need to understand that. We saw all the boxes and errors on when you try to explain the previous guarantees. It's a complex instrument, and we also talked about that we need to make sure that there is an alignment of interest, and sharing risks is an excellent tool to achieve that. And that is something that donors really need to understand as well, because sometimes even grant donors are quite risk averse as well. So we need to cut down the transaction costs. We need to find models and replicate them and scale them up. We need to take care of the demonstrational effects so that they get institutionalized, so that if we find a model we have heard 2 examples, we need to really also leverage them and scale them up. Still, there is always talk about investment opportunities that needs to be developed, and everyone says that. No one takes ownership of that question really. It's always bounced around that there needs to be more bankable projects, but who in the system takes the lead on that one? We also need, specifically if we want to tap on the big capital and the big institutional capital, we need to aggregate in a smart way. The ecosystem there needs to function if we are to bring institutional capital all the way down to the most needed. So I think that for grants and ODA, I think that we should scale up we should do more of what we are doing, but we also need to think, when we talk about capacity building and institutional building, then we should look at it from how do we build that institution that could tap the potential of using blended finance. I think, we need to develop this business model. Pay-as-you-go have unlocked enormous potential. I know from a telecom operator in an African country that started to sell airtime scratch card to a lower ticket size, then all of a sudden their market grew. And we know what mobile money has meant for those in the margin. So those type of innovations are, of course, very important. I would like to also say that, investment mandates and expectations are set by owners of capital, and perhaps talking about elephants in the room, owners of this capital could be shareholders, but also pensioners, right? Present or future. So there is a lot of owners in this meeting. So what risk appetite are we willing to take with our pension, future pension? And we should keep remembering then that when we do our transaction, because we cannot only talk, we need to also face those realities that we need to keep an eye and an understanding on, that guarantees are trying to use others' money to do what we want to do, achieve. One thing that has been heard, which I think that we should press on as well further, is that, and that also relates to the first intervention I had, is that we need to know the risks, and the rating agencies, they play a huge role. To me, they combine perceived and actual risk, but we need to work more on the visibility of the actual risk, and I think that the combined system needs to deliver more data to the market, so those risks could be closer to the actual risk. So I think I stop there. It's a long agenda, and it's even longer if you look at it more detail.
No, thank you very much, Ali. And of course, it wasn't a fair question, but it was. I think you brought up a number of good points, right? Like more bankable projects. That's what we often hear. More capacity with governments actually to prepare these often infrastructure projects so they become bankable. Takes a lot of time. When it comes to small deals, there's often talk about aggregation and diversification. So you aggregate them and you get a lot from different themes or geographies, and then you can actually package them and sell them off. And that could be a way, right, that you can do. So those, and then investment mandate, which goes to institutional investors, which you mentioned, but also to DFIs and IFIs, where you have government's own ownership, and what can they do to be more aggressive in frontier markets or LDCs or IDA countries. Now, I also wanted to see if Jagdeep or Fatu, and I don't want to put you on the spot, but we were talking about collaboration. So if any of you have any experience that you want to share from your different points of view of your projects, I'm happy to let you in. I also want to hear from the other panelists if anybody of you have any good ideas how we want to change the international financial architecture, and if you have any measures that you want to share with us. You know, this is the panel when you can do that. So first, I'll go to Jagdeep. Do you want to add anything from your presentation now when you have heard the panelists?
Thank you so much, Andres. Certainly, I think I'll just echo some of the things that were already shared by Caroline and Ed, particularly on the collaboration part. We are all now seeing that there is a more and more push of delivering as one with the UN reforms, and then the UNDAF or UN Sustainable Development Cooperation Framework becoming more and more taking the center stage in terms of coordination, has really helped us to start looking at collaborations within the UN agencies. And then it's also very interesting to see how in one specific area, multiple things can be included. Just to give us an example, like in this particular guarantee, as we talked about UN Women as well as UNDP both supporting, UN Women's focus was on the market vendors, which is purely informal segment, and then it directly ties into their work for under the Markets for Change, where they have helped develop the market infrastructure and working on the governance. And then this particular piece of guarantee targets on that segment. Similarly, for UNDP, the segment was more of mature entrepreneurs and also those who are outside of the market segment. And then looking at the profile and looking at how we are able to combine this and make the offering to a whole range has been possible. In addition to that, I think as Ed mentioned, probably for us in particular here in Papua New Guinea, it's quite common to work in joint programs. The Highland Joint Program he mentioned has 6 UN agencies. We are part of the STRAIT project, which is 5 different UN agencies coming together on their respective areas. And for UNCDF here, we actually have 4 projects which are joint projects. And looking forward, we already have further engagements going on use of similar tools and instruments, like the one on the Global Fund for Coral Reef for the development of blue economies in Papua New Guinea. That's again a joint program of UNDP and UNCDF, where UNCDF plays the role of providing the guarantee and engaging the financial sector. So quite a bit of synergies that we are seeing, and not only at a country level, but also then it expands to the regional level, where we are working with other Pacific Island countries on similar kind of initiatives, which is also critical to mention because many of these island countries are too small and not so lucrative for the private sector players to come in and operate in just one country. So when we go as a group, it just becomes much more attractive proposition for the private sector to come in. Back to you, Anders.
Perfect. Thank you very much, Jagdeep. Fatu, do you want to come in and say anything about the collaboration? Or?
Perhaps just to add on to collaborations and the importance, I think there's probably a big opportunity here for public-private partnerships and perhaps future collaborations between UNDP and UNCDF, for example. Because when it comes to utilities or councils in Africa in particular, they often are struggling financially, so they're unable to utilize private sector to deal with issues in either energy or even waste management, for instance. So I think with the incorporation of guarantees, such as the one under the project that we showcased today, you're really able to tackle certain issues through engagement with private sector that otherwise wouldn't be possible without a guarantee function. So I would just say that in setups like this, it would be, I think, very useful for UNDP and UNCDF and similar organizations to continue to play off of one another and utilize our strengths to deal with these larger scale issues.
Excellent. Thank you very much, Fatu. Now, I parked the question on the international finance architecture. Anyone that is appetizing taking on that? I also have seen some questions in the chat. Two of them I can easily respond to myself because they are about UNCDF. So I'll do that. Then there is one question where they're talking about, well, here our discussion is very much on the top down. How do we come with the finance from the top down to somebody? And this person was asking, how can we combine a bottom-up approach, right? The person is saying, I'm supporting a bottom-up approach, raising money for startups that support SDG positive businesses. You are supporting a top-down approach. Both may be necessary, but there's a huge gap between them. How could we meet? That's the question in the chat. So anyone that wants to answer that as well. So we have two questions, and the big question and these questions. And meanwhile, you're thinking about answers and coming forward, I'll take two more that was in the chat. One was, does UNCDF take collateral? So actually we, and how can we help women-led businesses when they don't have a lot of collateral? Well, one way is to, like we've done with the Women's Bank, right? We provide a guarantee to the bank, so the bank doesn't have the collateral requirements that they usually have. So the guarantee that comes from UNCDF or from Sida or for somebody else is replacing that requirement. So that's one way. When it comes to loans, the loans that we are issuing, we're actually issuing without taking any security. So we're not requiring that on our own loans from our balance sheet. Then there was a question on the average interest rate. If that was, how do UNCDF actually provide an interest rate? So what we do, what it says in our policy is that we should try to minimize the subsidy. So we want to minimize the concessionality in the interest rate. So we run the financial model of the business. If we see that the business can absorb 5% interest rate, we charge 5%. If we see that they can absorb 10%, we charge 10%. So we try to not subsidize too much. On the other hand, we want the business to survive, so we don't charge an interest rate which may not make the business sustainable. So let me see if there's any takers on the questions, the two questions I had there. Ed.
Yeah, and there's, I'm very happy to give the international financial architecture question a crack. I'm feeling emboldened. It's a really interesting question. I think by many measures, the architecture is changing quite quickly. I think we need to, you know, we have this problem in development circles often of compartmentalizing ODA out of a much larger ecosystem architecture globally. We think that it's somehow special. On the other hand, we talk about it being an instrument for change or an instrument for leverage. And I think ODA ultimately is an instrument rather than a solution. It's part of a suite of solutions that we need to pursue. I think ultimately that question about changing the international financial architecture is one that needs to be driven by member states. And it will be considered and is being considered within tax regimes and labor mobility and transfer pricing. And there's a whole bunch of things that come into play at this point. But the other, I guess, the thing that is of particular interest in places like Papua New Guinea is very much this question of public-private partnership. And one of the speakers raised this previously, and certainly infrastructure is the obvious one. We have, like many emerging economies, enormous potential, but this very, very draconian bureaucracy that often expresses itself through this sentiment of a privatization through SOEs. And in PNG, there's not one SOE that works particularly well. In fact, they're all just hemorrhaging money, and they have been for many years. But we do run a risk in a place like Papua New Guinea where the instinct is to privatize the utilities, it's electricity and water. That often is the first port of call. And I can't help but think in a country that's only 15% electrified, 15% of the country has access to electricity. If we were to privatize that, what would that actually look like and what would it mean? And I think the question of sensible regulation and thinking through the dynamics of those public-private partnerships are very important. But the reality for an economy like ours, and I think Jagdeep had some GDP numbers earlier, is that the cash position of government, while there's a lot of money in the economy, the cash position of government is terrible. It's diabolical, frankly. And that's a role for a lot of grant donors to step into, either with highly concessional loans, as has been done recently by Australia and Japan and the US, or to look at coming in and offering a response in a critical area of reform. For us, electricity is an absolute critical. I would argue land, although that is a very difficult one to touch in the Pacific, 95% of the land is customary and it's not titled, and it probably will never be titled. So I think that question of changing the international financial architecture cannot be discussed in our ecosystem unless we sit in the broader architecture. We can't forget that aid is an instrument of foreign policy. Ultimately, you use it to shape behavior. You incentivize change towards better normative standards, improvements in trade, reducing tariffs, because you recognize, I think we all recognize, that unlocking capital and opening opportunities is very important. But fundamentally, that question, I think we run the risk always of making it a very artificial conversation, because the Bretton Woods system as we know it, as it pertains to us, is under extraordinary stress at the moment. I know in the UN system, the current crisis in Ukraine with the invasion by Russia is raising lots and lots of questions about, are we equipped for the future? And I think that question about, if you want to change the international financial architecture, there are two questions. Are we appropriately calibrated as a development community to shepherd, participate, or shape that change? Two, what would be the purpose of that change? And I think that understanding why you want to change the national architecture is a very important place to start that conversation. I'll leave it there.
Great, thank you very much, Ed. I think those were very, very valid comments on a very difficult question. I think, advocating policy reforms, domestically, but maybe also internationally, and link that or incentivize that to funding is something. We tried that with many of the, in the 90s or beginning of but that wasn't really very successful, right? But maybe taking a new stab at that and see if you can do that again, and try to see a domestic policy reforms advocating for more investment climate, etc. I see we're running out of time, so I'm going to just very quickly comment on the bottom-up, top-down question before I hand it back to Abhishek. Obviously, both are needed, and I think many of us, not least around this table, is working on different levels. So when you have a challenge fund, you're really supporting startups. And when you have a challenge fund, you need to think about how you are actually getting that promising business to the next step. And often you can provide a grant at the first stage, and then you may need a concessional loan, and then you go to more of a commercial loan. In UNCDF's terminology, we call it the investment continuum, and it's important that you have tools for each of these steps, right? So you nurture this company all the way to commercial finance. It's never a UN's or SIDA's or anybody else purpose to stay in businesses that are growing. Then you'll take out your money and then you invest them in new startups. So I think that's pretty much what you want to see in an investment continuum for many of these companies. And then of course you couple that with business development support. So you in the startup you often need some capacity building with the entrepreneur. I want to thank the panel. I want to thank first of all I want to thank Fatu and Jagdeep, and then also I want to thank Kalle, Ed, Caroline, and Gunanidhi for excellent interventions. And I give the floor now back to Abhishek.
Thank you, Anders, for moderating this very interesting discussion. I would now like to invite Mr. Ola Sellen to give his closing remarks. Mr. Sellen is Senior Program Specialist at Sida. During his 30+ years at Sida, the first half was devoted towards blended finance and concessionary credits within infrastructure, mainly to China and other Asian countries. The second half has been devoted to financial inclusion in a broad sense. During the mid-2000s, he, among other things, participated in the startup of the microinsurance network. Mr. Sellen is also UNCDF's focal point at Sida, and I would now hand the floor over to him for his closing remarks. The floor is yours.
Thank you, Abhishek. Yes, and as a focal point for UNCDF here at Sida, I'm very honored to be given the task to provide the closing remarks. It will be my 3 minutes of fame, and I look forward to that. So I think, or at least I thought, that I was fairly acquainted as a focal point already with the activities of UNCDF. But I have been reminded that there are so many different aspects of your activities. So there's always potential to learn more. So that was great. Thank you. And I would like to start and thank UNCDF for arranging this so-called associated event. And Sida, we are co-hosting it, but in practice, in reality, you made all the preparations, including putting together this panel. So thank you also for that. And we had the privilege to listen to different and interesting case studies in the beginning from the Gambia and PNG. And also we heard a lot about UN collaboration, and of course the international finance architecture was also a big topic throughout the event. So I would also like to thank the presenters and all the panelists, including local representatives from UNDP, UN Women, and staff from UNCDF, and from Sida here also, colleagues. And I think you all provided valuable insight and food for thoughts. And I would also, of course, like to thank all the participants in this webinar from wherever you are located, and you also provided questions that added to the discussions. And finally, also, I would like to thank the moderator, Anders and Abhishek, for guiding us through this event. And we all know that this associated event was under the umbrella of Stockholm+50 conference with its broad and vast agenda related to environment and climate change. And I think we all agree that questions related to financing are important. And as was mentioned by Preeti in the beginning, it's hardly new. And so it was not the first occasion when these questions were discussed, and probably not the last either, but maybe at least we took a one step ahead through this discussion. And I think it was encouraging to how this event was more, down to earth related issues, and we heard it was a focus on areas like transaction costs, private sector engagement, financial literacy, skill training, business development support, and many more issues were mentioned. And also, of course, how to reach small scale in the last mile, but also, of course, in the longer run, how we reach impact and systemic change or market development, as it was mentioned. So once again, thank you all very much, and I think my 3 minutes of fame has ended.
Thank you very much, Ola. It was a pleasure to have everybody around here today. And with that, we will close this hybrid event. Thank you so much. Have a good day.
Thank you.
Thank you.
Thank you.